In this episode, we'll show you how having the right mindset is crucial to your success as an investor. So today I've got a very special guest with us, Peter Dean. Now, Peter is a highly successful investor in his own right and is also a coach on our Investment Academy program. So Peter runs the investor mindset class on our program. And actually, today's episode is all about investor mindset, and he's going to explain how important that side is. How we think about investing is really what separates successful investors from the average ones. And that's why I thought this episode would be really important for us to just get that grounding in terms of how you think as an investor. And usually, if someone's looking to invest, the first question you might ask is, well, which stocks should I be buying? Or which ETFs, or which funds, or options, or crypto coins, and inside which platforms? Now, all of those things are really important questions, and we absolutely have to cover those off. And we cover those in our Investment Academy very, very clearly. We give you all of that information in a clear way. But that's not what we master first. We first focus on how to think like an investor. And that's the critical thing, because that's really what's going to move the needle and help you secure your financial future. That's why after doing the Investment Academy, so many people leave as successful lifelong investors. We don't just tell them what to invest in. We train them how to invest in any situation for the long term. And that really comes down to how to think as an investor, which Peter is going to explain and go through in a bit more detail with us today. And really, that's why people obtain great returns over the long term, if they're able to think in the proper way and think as an investor. So I know, Peter, you're going to explain a lot more about what I've just talked about there. By way of an intro, Peter is a successful multi-asset investor across different asset classes, different across property, stocks, options, crypto, and regular ETFs. Peter also qualified as an investment coach. As I mentioned, he's a coach on our Investment Academy. So welcome to the podcast, Peter. I guess two questions. Did I explain all of the asset classes you're invested in? Did I miss anything out?
No, I think you've got them all. Thank you, Manish, and thanks very much for inviting me to your podcast. Looking forward to it.
Great. Okay, so glad we've covered all of that off. So I guess the first question for you, Peter, before you dive into,
Mm.
your content, which is super fascinating, by the way. What do you think makes a successful investor? What do you think a good investor, how do you think a good investor thinks differently compared to an average investor?
Sure, great question. I think it's an equal balance between having the knowledge, but having the right behaviors and being aware of your behaviors and being as calm and as rational as you can possibly be when you're investing. And that isn't always easy. So when I trained as a financial coach, and one of the things that fascinated me during that training was understanding how your mind works in relation to money, because money is a very emotional topic. Really, it's ridden with emotion, good and bad at times. And everybody thinks when they're making investment decisions that they're behaving rationally. 9 times out of 10, it's your emotions that are driving that decision rather than your rational mind. And I'm trying to explain that is everybody knows rationally what to do in terms of managing their money. Okay, everybody knows. We all know that the secret to building wealth is don't spend everything we earn, save and invest the difference wisely. There you go. Everybody knows that. All right, that's no rocket science. That's the secret of financial well-being. But why don't we all do it? If we all did it, we'd all be successful investors. None of us would have any bad debts. We'd all be able to retire early with a great pension, with a great big pension fund. If only. Yeah. Our mind sometimes gets in the way and trips us up.
Yeah. Absolutely. And that is so critical, because when in the day-to-day sort of action of investing, when we're looking at our portfolios, it's hard to separate the emotion from the rational side of things.
Yeah.
Right? And also, just related to what you said, information is all around us. So we can, if you wanted to learn about stocks and various other investment vehicles, there's tons of information out there on YouTube, everything else.
Yeah.
But really the key thing is, how do you go about implementing that? How do you go about thinking about investing? And not just today, but around the corner when there are events going on, when there's market volatility, if there's a bit of like we saw during COVID, we had a crash. How do people think around those times? What is the correct way to think, right?
Absolutely.
Mhm.
Absolutely. Yeah, absolutely. You need to be aware that sometimes your mind, well, normally, always, your mind will wander and do things you don't want to do, first of all. Okay. It'll be too excited, it'll be too scared, it'll be too angry, it'll be frustrated. That's how your mind works. And when we get a
Fight or
chance, I will
flight. Fight or flight
exactly
is
that, fight
an
or
instinct.
flight, exactly that. And we'll go into that in a little bit more detail when I show a couple of slides. And that's one of the things we need to be aware of. And the worst thing we can do is fight that. We
Mm.
need to be aware of that, understand that it's going on, and develop tactics to let it calm down, to let your mind calm down before you make any investment decisions.
Absolutely, absolutely. It's so important. I mean, yeah, we were talking about this the other day, and we were talking about we had the last significant market crash was during COVID, which is actually
Yes.
about was it about 5 years ago now, right? I look back at that time, and I was buying around that time, buying some investments, thinking about picking up some bargains. But actually, if I look back now, I would so love to turn back the clock and just buy up a lot more, right? Because it was
Yeah.
now it looks so obvious that it
Yeah.
was
Yeah.
just
Yeah.
a
Of
sort of
course it does.
short-term
Absolutely right.
crash. But if you remember that time, we were all just running scared. It was that whole fear, and every instinct in our body was telling us to get out of all of our investments. And
Exactly.
and looking back now, we should have been buying. But all of this comes down to mindset, right?
Yeah.
Is
Absolutely.
what you're going to
It's
be
been
talking about.
absolutely. Yeah. Yeah. Shall I share a couple of slides?
Yeah, let's share
Let's do.
some information now. If you're listening to this on the podcast, obviously you won't have access to the slides which Peter is
Yeah. Of
about to
course.
share with us. But what we'll do is we'll put the slides and the images into the show notes, so you'll have
Great.
access to those while you're listening in. So yeah, feel free to some information there, Peter.
Okay, so the first point I want to make, and just a few slides to talk through here, is that we're not biologically wired to be good with money, or for that matter, investing. And the reason why that happens is that our brains were formed millions of years ago. Prehistoric man, primitive man. That's where our brains have their genesis. And life was very, very tough there. They had two things to do basically: to hunt for food and avoid being hunted for food. And life expectancy was roughly about mid 30s or something like that. So life was very short. There was no long-term future. Everything was very much in the moment. Their senses had to be primed to danger and been able to fight or flight, as you mentioned earlier. And that's how our brains were formed during that time. And because they're the longest, most established part of our brain, that is where our prime emotions come from. That primitive man is where our emotions come from for any decision, not just money, not just investing, but in particular money or investment, because they're loaded with emotions. There's a great book called The Chimp Paradox by Steve Peters that goes into this and explains it really well in a really simple way. Steve Peters, some of your listeners may be aware of the name. He was one of the coaches, did some work with the British Olympics team for 2012. And he's done some work with other famous sportsmen since. And he explained that the three main parts of our brain work together, and that they are the frontal part, which is our human part, the limbic, which is our original chimp part, he refers to it as. So that's the bit that dates right back down to right way the way back to prehistoric man, and the parietal part, which is the logic part, the computer, where we store information, where it's our shortcut to information. It's where we don't have to think about every single thing we do, because we instantly know that's how to do it, such as tie our shoelaces or make a cup of tea or anything like that. We store all that information. It's instantaneous. Now, the important part to remember about how these parts work together is that your chimp part is 5 times stronger than your human part. So that's the bit that is built in to protect prehistoric man and to make it a successful hunter gatherer. It's very emotional. It's very quick. It's very spontaneous. It's very in the moment, and which can be both good and bad. But the point is that it's instant, it's quick, it's very, very, very emotional.
Mm.
If you try and argue, imagine yourself trying to argue in your mind with the chimp, you won't win. Your logical part, which is your human brain, it won't win that argument, not in the time, because the chimp is stronger. Our emotions are stronger than our logic at this time. So the trick really is to let it calm down. It wears itself out. It takes up so much energy, so much energy. Imagine when you're frustrated about things, or you're angry, or or you're happy. It uses a lot of energy. So it takes up so much energy from our mind that eventually it does calm down. So you need to be aware when that's happening. in investing context, but also in your everyday life, a useful trick to have in your everyday life. Let it calm down. How many times have you got involved in an argument, had a blazing row with somebody, only to regret it later and think that was a bit silly? And of course, it is silly. When you look back and it's silly, but in the moment, in that time, it's important. And your chimp is getting you to do this.
That's really fascinating, Peter. And I guess just thinking about what you've just been saying, if we apply it to investing, is it fair to say that emotions get the better of us, right? So when we are looking at newspaper articles or social media posts, or when people are just fear-mongering, etc., is it fair to say, given what you've just said about this sort of chimp paradox idea, is it fair to say that actually what we should be doing is yes, okay, just almost ignoring the highly sort of emotional aspects of investing and really just focusing on the evidence? Is that fair to just keep it to the evidence and keep it rational from that perspective?
Yeah, absolutely. Keep it to the evidence. Let your human part of your brain do its work, because it knows the right thing to do. It's the logical part. It gets taken over by the chimp part initially, but it knows what to do eventually. Okay, it will always know what to do. It knows the right thing to do. Your emotions sometimes cause you to do the wrong thing to do. So we can come on to a couple more tips on that. But the most important tip at the moment is don't do anything in a hurry. When you're looking to make an investment decision, don't do it in a hurry, because it's your emotions that are driving that decision probably. Don't do anything when you're too excited or depressed. So equal way, just don't make investment decisions when you're in that frame of mind.
Yeah.
Calm yourself down. However that works for you. Read a book, go for a walk, go to the gym, do something to calm yourself down and get that chimp out of your mind, right? Your rational mind working.
I
Have
agree.
a pause before you're actually going to make an investment decision. Even if you come to that decision, maybe sleep on it, or maybe just leave it a few hours. Nothing is so urgent. Very little things are so urgent that they won't wait with another little 24 hours to go. And then if you come back to it with your rational mind and you think, yeah, it's still the right decision, more than likely it is the right decision at that stage. But if you come away and you think about it and think, yeah, that maybe wasn't the right decision.
Yeah, I completely agree with that. And that reminds me of this whole, there's a whole sort of separation between trading and investing. And I'm always reminding people to invest and don't trade. And there's a big difference between the two. The trading side, I think, involves, and now you've just talked about this idea, I think it really fully utilizes the chimp side of your brain, right? The trading
Yeah.
side, because you're responding to things and events and what people are saying. Whereas investing, you're keeping a cool head and you're just focusing on what's always worked. Now, that's not always easy, but you just need to learn how to invest in the right way. But once you've learned how to do that, it's a forever thing, right? And that forces you to, or teaches you how to think about what's always worked and the evidence rather than reacting to short-term events.
Absolutely. Absolutely. Let's move on. So, yeah, some concepts that exist in terms of how this can affect you as an investor that I think will be helpful for the listeners to be aware of. One of the things is that we fear loss more than we value gain. It's a strange concept to understand, but actually, because we have something, because we already possess it, we're worried about losing it more than we are about gaining something, because we can't really envisage it as well. We haven't got it. Now that's a concept that works across a number of things, but in an investment context, this can mean sometimes that we make the wrong decisions, because if we're sitting on a loss, and it might well be a loss that we'd be better to crystallize. Sometimes we hang on to that too much because we don't want to make that loss. Yeah, because we know that our rational minds may know that actually that's not the right investment for us to be in anymore. It's not every investment we make is always going to be a winner. We know that. The trick of investing is to get more winners than losers and to win overall. That's what we do. So sometimes you need to recognize the loss and walk away from it. And sometimes almost that's a bit like admitting defeat. Don't get, again, a little bit emotionally attached in that. Don't get too personally attached to your investments is another great trick to keep in mind. So bear that in mind.
Yeah, I think just to add to that, Peter, is this whole idea of a fear of loss is sometimes overtakes the pleasure from the gain, and which is what
Yeah,
you're saying, right? And
yeah,
just to kind of
that's right.
provide an example of that is where I see this translate into where people don't invest, and people hold on to cash for
True.
for far too long. So they hold on to too much cash for too long, purely from the fear of pain of loss. And
Yeah,
actually, when we are investing, all going back to the evidence, right? Going back to the evidence suggests that investing, particularly in stocks, has made a very consistent 8 to 12% per annum. Obviously, we don't make gains every year, but that's part of the game. That goes with the territory, right? Historically, it's been a very lucrative asset class. But what people fear is the pain from loss. So the it's almost like a sense of security to sit in cash for far too long. And I would say,
yeah,
look, be aware of inflation because,
yeah.
anyways, cash is by far the worst asset class out there. So yeah, so this kind of just reminded me of that sort of
But that's a really good point, man. You're absolutely right. And some of that can manifest itself in procrastination.
Mm,
So people may be fearful about loss and maybe thinking, well, you know, there's been big gains in that particular ETF or that particular stock. So I wish I'd invested 20 years ago, whatever. And so yeah, maybe you'd have been better there. But you haven't got that 10, 20 years ago. So that might have been the best time to invest. The best time to invest for you right now is today.
mm.
So think about overcoming that fear of loss and actually dipping your toes in logically and begin your investment journey. So don't let that hold you back.
Totally. And if you're really cautious, pound cost average in because that
Of
enables
course,
you to drip feed money in without going all in.
absolutely. Another concept, herd mentality, following what everybody else does. We're all guilty of this because the reason why we do this is that we're social animals. We want to be seen to be in the in crowd doing the same as everybody else. We don't want to stand out. So sometimes we're making decisions that just because everybody else is making them, we want to make decisions as well, those decisions as well. Now, it isn't always going to be the right decision, and it certainly isn't always going to be the right decision for your individual circumstances. So just because everybody else is doing something, it doesn't always make it right. Going the other way, there's a concept called confirmation bias, which basically means that we seek to find out information that reinforces our view, and we only look for that information and we become completely blind to all the information, all the wad of information that actually challenges our view. Again, it's reinforcing our self-belief that we need to be open to that. And we need to make sure that when we assess something and when we ongoing assess our investments, make sure that we're taking in all considered points of view as well, and not just going blindly on our own confirmation bias as well.
Mm. Yeah, very important. Absolutely.
And the last one I just want to talk about briefly on here is FOMO, the famous fear of missing out, linked heavily to herd mentality. The problem with fear of missing out is that very often you will end up doing things in haste for the wrong reasons, again, because everybody else is doing it. And moreover, you end up doing it at the wrong time, very wrong time, because when everybody else is going into something, that's usually the time where it might be due some sort of correction.
Mm.
So you can end up buying into a stock or an ETF just because everybody else is buying into it. And conversely, selling out at the wrong time when other people are selling out as well. So be consistent in your own investing approach. Don't dive into an investment because of FOMO or out of investment because of FOMO as well.
Absolutely. I see that a lot, herd mentality, and you see that. And the one easy way to mitigate those biases is to be diversified, right? So there's nothing wrong with playing
Absolutely.
individual stocks and cryptos and things like that. Make sure you're positioned properly. So if most of your portfolio is properly diversified, even if you get the herd mentality FOMO wrong slightly, if you fall for that trap, which you shouldn't, as Peter's mentioned, you should try and think about not joining that crowd. But even if you do, as long as you're properly diversified, it won't be so painful when it goes against you.
Yeah, absolutely, absolutely. And the last concept I just want to refer to is something called present bias, and that is very much the fact that we are happy, we are happiest living in the now rather than the future. We find it hard to envisage our future selves. And going back to prehistoric man, that's mainly because that part of our brain was formed, the strongest part of our brain. There wasn't a future self to look forward to in the sense that there is now, with a life expectancy of mid-30s. Now, this goes a long way to explain why people don't maybe start that investment journey, and certainly a long way to explain why people don't save as much for their future self, in particular pensions, as they should do. They know they need to, they know they should, but they don't. Now, of course, there's sometimes financial concerns holding that back as well. We need to live in the moment and have our everyday spending taken care of. Nonetheless, if we had a bigger and better appreciation of our future self, we'd be much better longer term investors as well. So long term time frame is what we always need to think of investors.
Absolutely.
We invest for decades, not days.
Yeah, totally. And that is so important. Having that long term horizon is so important. I think about Warren Buffett, right? Warren Buffett is, how old is he? 94, I think now,
Yeah,
or
roughly, yeah.
something like
Yeah.
that. And when people ask Warren Buffett what his time horizon is, he says it's forever,
Yeah.
right?
Yeah.
So
Yeah.
because, and the reason for that is because, and I think we should all have that same mindset, because when we're investing, we're not just investing for ourselves, we're investing for our future generations. Hopefully we can
That's
pass
right.
on assets to
That's
our
right.
generations, and really and that's why we should be responsible investors, not just for our future security, for others around us, I think. And just the final thing on time, on long-term investing, it reminds me of a story. I don't know if you probably heard it, Peter. It's the Fidelity story, and
Yes.
some of our listeners may have heard of it, but
Mm.
and the reason I mention this is because it's so important. This actually, what Peter's saying, has huge, real consequences for how well you'll do as an investor. So this Fidelity story it's a really famous story. And so you've probably heard of Fidelity, the investment platform. It's a huge US based investment platform. And what it did was one day it decided, some of the marketing executives decided, actually, let's have a look at all of our clients, all of our investors, to see how well they've been doing. Let's go through their accounts and let's segment them from the best performing to the least well-performing accounts in terms of investors. So I think they split them into 5 different parts: the best performing, second best performing, and etc.
Yeah.
So and they decided, okay, well, let's take this opportunity to contact our best performing investors, to let's see if maybe we can extract a few more dollars from them, to get more fees out of them. So let's use this as an excuse to give them a call. So they
Mm.
did. So they contacted the best performing investors, and they gave them a call to say, hey, how are you doing? What's the secret, etc. So they call them up, and to their surprise, they couldn't reach most of these people.
Mm.
And eventually they got through to their families, the account holders' families. And what they found is that a significant percentage of these investors had died. And they were amazed by that, right? So most of these investors had been around for so long and they died, and their families hadn't even looked to close down their accounts. And then they decided to call the second best performing group. And they call them up, and again, to their surprise, this time they were met with surprise from the other side to say, "Oh, I don't have an account with you." So it turned out
That's
that they'd
right.
actually forgotten that they'd had an account.
That's
And really,
right.
the moral of this story, which the Fidelity people had found out, the moral of this story is that actually the best performing investors just don't tinker with their
Mm.
portfolios. They'd almost forgotten, or if they died, they can't tinker with their portfolios, or if they don't know about their accounts, they haven't been able to tinker with their portfolios. And the worst performing investors are the more active investors by default as a result. So this is all it completely links into what Peter's been saying about not following the herd, not tinkering with your portfolio, investing for the long term, because this stuff really matters. And these Fidelity people actually found the best performing investor groups had returned something like 18, 19% annualized for years and years and years. And imagine that compounded over time is just multiplying your wealth by an amount you wouldn't be able to imagine, right, Peter?
Absolutely. And that so powerfully demonstrates the power of long term compounding and being a patient investor.
Yeah, patient
Absolutely.
investor is the key thing. Absolutely.
So, some tips. What now we know that our mind is driving some of our investment behaviors not to our benefit. What can we do about it? as an investor, as you well described at the beginning, Manish, behavior beats knowledge. You can have all the knowledge about how to invest in the world, all the knowledge in the world about how to be a logical investor, but your success will depend as much, if not more, on how you understand and manage your behavior and your knowledge, your technical knowledge. Think longer term. Invest according to your time scale, not everybody else's time scale, your time scale, which, as we've said, should be longer term and perhaps infinite in the case of Warren Buffett. Don't make short-term decisions, especially in haste. They can lead to mistakes and undue pressure and undue. Learn to control your emotions. Spot when you're getting emotional. Avoid herd mentality. Avoid social media influences. Don't listen to what these guys say or these girls say. They don't know you. They don't know your circumstances. They don't know your time frame. They don't know what else you've got. They don't know your assets. So how can I make a recommendation for you? Yeah, don't listen to them. Invariably, they're just selling clicks and trying to get people to view their channels and monetize their channels, social media channels. Prioritize not losing money. Stay invested. Stay invested. Don't make hasty decisions. Let compounding do its long-term work, because as we've seen from that Fidelity case, amply demonstrates the fact of long-term, consistent patience and compounding. Embrace volatility. Yes, it can be scary. Yes, it can seem as though the whole world is against you in terms of investing. Yes, it can be really worrying about your investments going down, but that's when shares are on sale. That's when there's the opportunity for you to dip in a little bit more and add rather than shed. Don't look to be worried about volatility, because long term, as we've demonstrated, and as you teach on your investment academy, Manish, the markets trend upwards long term. There will be dips along the way. There will be dips along the way. Of course there will. There'll always be dips. These are the volatility. Volatility is the price we pay for the rewards. Without volatility, there's no rewards. And we talked about overtrading. Avoid overtrading. Avoid the temptation to dip in and out. Avoid the temptation to tinker. Jump horses. Stick to your long-term thesis. Stick to regular investing. Be patient.
Totally. I love those tips. And that is a perfect summary of not just investing and what we talk about all the time. It's a great summary of what you teach, Peter, in your excellent mindset class. So Peter, as I mentioned earlier, Peter is an investment coach on our investment academy, and Peter provides a fully comprehensive class around all of this stuff, which we've summarized today. But this is so important to be a better investor, right? So and really, as I said earlier, this stuff comes first, right? Get this right, and everything else will just fall into place. We can learn about the stocks and the ETFs and the funds, what to invest in, how to invest it in, how to save fees, how to create lumps of capital, which HMRC will give you if you put money into your pensions properly, all the right wrappers, all the right platforms, options for income, dividends and crypto and all of that good stuff. But this comes first. If you let these be your foundations for investing, this will stay with you for life, and not just you, your family and your friends and those around you, because this is all contagious stuff. So really, if you do this, if you master all of this, you'll become one of the top 5% investors in the world.
Yeah. I mean, I love this stuff. It's really helped me as an investor, without a doubt.
Every time I hear this stuff, and I've heard this a few times from you, Peter, but every time I hear this and talk to you about this, there's more and more light bulbs that go off in my head, because we're always learning, right? Doesn't matter how experienced you are, you're always learning about this stuff.
Yeah, absolutely.
So it's so important. As I mentioned, Peter gives a much more comprehensive sort of class around this stuff, and we talk about all of this within what we call our investment foundations, which we build upon. All the other stuff comes afterwards, but these are your foundations. Just like when you build a new build property, right? We lay our foundations first, right? And when you lay your foundations first, that makes for a long-lasting, robust portfolio. Your portfolio is not going to be blown down by the wind. In the same way, the foundations help your property to stay upright and to stay robust for decades, if not centuries. So that's been really fascinating, Peter. Thanks so much for your time and your knowledge and sharing your experience with us on this episode. and hopefully that's helped all of our listeners and our viewers as well. If you want to find out more about the Investment Academy, go along to investlikeapro.co.uk, and please give us a follow and a subscribe, and hopefully you can check out our other videos, which hopefully should be showing up somewhere on this screen over here. So go and check out our other videos and our other podcast episodes, and I will see you next time.